Ladies and gentlemen, pay close attention, because moments like this do not whisper, they announce themselves. When silver surges $10 in just 5 days, that is not a coincidence, not speculation, and not noise. That is a signal. Markets do not move like this unless something beneath the surface is breaking, shifting, or being repriced in real time. And right now, the people who have controlled this market for decades are not calm, they are panicking. For years, silver was dismissed, suppressed, laughed at, and strategically undervalued. It was called boring. It was called dead money. But while the crowd was distracted by hype and headlines, something else was happening quietly. Physical demand was draining inventories. Industrial use was accelerating. Monetary confidence was eroding. And now, suddenly, the pressure has reached a breaking point. A $10 move in 5 days is not a rally, it's a warning shot. Ask yourself this: when was the last time a truly controlled market behaved like this? This kind of price action tells you that supply is no longer meeting demand at the old prices. It tells you that paper promises are being challenged by physical reality. And most importantly, it tells you that the people who rely on stability, predictability, and leverage are losing control of the narrative. This is not just about silver going up. This is about trust going down. Trust in currencies being printed without restraint. Trust in debt markets built on endless rollover. Trust in systems that require everything to keep working perfectly, or else. Silver is not moving because traders are excited. Silver is moving because the world is waking up to risk. Here's the part most people miss. Silver is not only a precious metal, it is an industrial necessity. It sits at the heart of energy infrastructure, technology, defense systems, and electrification. You cannot replace it easily, you cannot mine it quickly, and you cannot invent more of it when shortages appear. When investment demand collides with industrial demand, price does not rise politely, it revalues violently. And that's why this move matters. A $10 jump is not the end of the story, it's the beginning of recognition. Recognition that silver has been mispriced. Recognition that inventories are thinner than advertised. Recognition that the old price ceiling was never real, it was enforced. And when enforcement fails, markets don't drift upward, they leap. Now let's talk about the number everyone is whispering, but afraid to say out loud: $100. Not as fantasy, not as hype, but as math. When silver last peaked in real terms, adjusted for monetary expansion and debt growth, today's equivalent is far above current prices. When you factor in supply constraints, geopolitical fragmentation, and industrial demand, the idea of triple-digit silver stops sounding extreme and starts sounding inevitable. The biggest mistake you can make in moments like this is thinking you still have plenty of time. Parabolic moves don't give invitations. They punish hesitation. By the time the headlines turn bullish, the easy gains are gone. By the time institutions admit what's happening, the price has already moved multiples higher. That's how every historic repricing works. First denial, then disbelief, then panic buying. What you're witnessing right now is that transition. The shift from complacency to urgency, from control to chaos, from suppression to discovery. Silver is no longer asking for permission to move. It's forcing the market to adjust. A $10 move in silver within 5 trading days is not a routine market fluctuation. It is a textbook example of price discovery breaking free from artificial stability. In efficient markets, prices adjust gradually as new information is absorbed. When adjustments become sudden and aggressive, it signals that prior prices no longer reflected true underlying conditions. This kind of movement suggests accumulated stress has reached a threshold where the market is forced to reprice risk all at once rather than incrementally. For years, silver's pricing mechanism has been dominated by paper contracts that vastly exceed the available physical supply. This structure can function only as long as confidence remains intact and delivery pressure stays muted. The moment that confidence weakens, whether through rising physical demand, inventory drawdowns, or geopolitical uncertainty, the gap between paper valuation and physical reality begins to close rapidly. The speed of the recent price surge implies that this gap was far wider than most participants were willing to admit. What makes this shift especially significant is not the magnitude of the move, but the timing. Volatility is emerging in an environment where monetary policy credibility is already strained and global liquidity conditions are tightening unevenly. In such conditions, markets become less forgiving. They no longer tolerate prolonged mispricing. When investors and institutions simultaneously attempt to reposition, The result is not a smooth adjustment, but a sharp repricing event, exactly like the one now unfolding in silver. This behavior exposes a deeper issue: the illusion of control embedded in modern commodities markets. Suppressed volatility often creates the false impression of stability, encouraging leverage and complacency. When that suppression fails, the release of pressure is swift and disorderly. The recent surge in silver prices suggests that participants who relied on predictable ranges are being forced to reassess assumptions in real time, often under unfavorable conditions. The most telling signal is how quickly sentiment shifts once price discovery resumes. What was previously dismissed as improbable suddenly becomes plausible. Resistance levels that once appeared immovable lose relevance within days. This is how markets communicate that a regime change may be underway. The question is no longer whether the previous price was sustainable, but how long the market had been mispriced before reality intervened. History shows that early phases of repricing are frequently underestimated. Initial moves are often labeled anomalies or overreactions, only to be followed by broader acceptance as fundamentals reassert themselves. A $10 surge in 5 days forces market participants to confront an uncomfortable possibility that silver was not merely undervalued, but structurally mispriced. Once that realization takes hold, price discovery does not pause. It accelerates, drawing in capital, amplifying volatility, and redefining what the market considers normal. The reemergence of physical supply constraints in the silver market represents a fundamental shift in pricing power, one that challenges long-standing assumptions about availability and responsiveness. Unlike financial assets that can be created or expanded through policy decisions, silver production is bound by geology, capital intensity, and time. When demand accelerates, supply cannot simply rise to meet it, and the market is forced to adjust through price rather than volume. That adjustment is now becoming visible. Silver inventories have been quietly declining across multiple channels, from exchange-registered stockpiles to privately held reserves. For years, these drawdowns were masked by paper liquidity and confidence in futures markets. Yet physical metal does not respond to financial engineering. Once inventories fall below critical thresholds, the market's ability to absorb shocks disappears. What follows is not gradual tightening, but sudden scarcity, where marginal buyers must compete aggressively for remaining supply. The constraint is compounded by the structure of silver mining itself. Most silver is produced as a byproduct of base metal operations rather than as a primary output. This means higher silver prices alone do not immediately incentivize increased production. Miners respond to copper, zinc, or lead economics first, leaving silver supply largely unresponsive even as demand strengthens. This structural rigidity introduces a dangerous lag into the system, where demand rises faster than supply can react. At the same time, industrial demand is becoming less flexible. Silver is embedded deep within manufacturing processes that cannot easily substitute alternative materials without sacrificing performance or efficiency. Once fabrication lines are designed around silver, producers prioritize access over cost. This transforms silver from a price-sensitive input into a supply-critical component, intensifying competition for physical metal during periods of tightening availability. What makes this moment especially precarious is the convergence of these forces. Inventory depletion, inelastic industrial demand, and inflexible mine supply are aligning simultaneously. Markets can tolerate one constraint at a time. They struggle when multiple constraints collide. When buyers realize that availability, not price, is the limiting factor, behavior changes rapidly. Orders are pulled forward, stockpiling increases, and the market moves from just in-time procurement to defensive accumulation. This shift is often invisible until prices begin to react sharply. By the time shortages are acknowledged publicly, the adjustment is already well underway. Silver's recent price behavior suggests that the physical market is reasserting dominance over paper representations. When physical constraints dictate terms, prices are no longer negotiated, they are discovered. And once that process begins, it tends to unfold faster and more forcefully than most participants expect. Industrial demand for silver is entering a phase where traditional pricing signals are losing their ability to moderate consumption. In classical economic models, higher prices suppress demand by encouraging substitution or efficiency gains. Silver increasingly defies this framework because its role in modern industry is not discretionary. It is embedded in technologies where performance, reliability, and regulatory compliance outweigh marginal cost considerations. As a result, Rising prices no longer reduce demand in a meaningful way. They merely expose how essential the metal has become. Silver's unmatched electrical and thermal conductivity make it irreplaceable in critical applications ranging from power grids and electric vehicles to solar energy, medical equipment, and advanced defense systems. In these sectors, material substitution is either technologically inferior or economically impractical. Manufacturers cannot simply redesign systems in response to short-term price movements. Production schedules, long-term contracts, and compliance standards lock silver into place, transforming demand from flexible to fixed. This dynamic creates a powerful feedback loop during periods of supply stress. As prices rise, industrial buyers do not step back. Instead, they step forward. The risk of production delays or supply chain interruptions far outweighs the incremental cost of higher silver prices. This leads to forward purchasing, inventory hoarding, and longer-term supply agreements, all of which pull future demand into the present and intensify upward pressure on price. The energy transition amplifies this effect. Electrification, renewable infrastructure, and grid modernization are not cyclical trends, they are policy-backed mandates supported by long-term capital commitments. Solar panels, for example, require silver regardless of market conditions, and global installation targets continue to expand. When policy objectives collide with constrained resources, price elasticity collapses. Demand persists even as costs rise, forcing the market to adjust through price escalation rather than consumption reduction. What makes this shift particularly disruptive is that industrial demand competes directly with investment demand for the same finite supply. Unlike speculative flows, industrial demand does not exit when volatility increases. It remains constant and often accelerates precisely when investors are also seeking exposure. This convergence tightens the market rapidly and reduces the availability of above-ground inventory that might otherwise stabilize prices. Markets often underestimate the speed at which inelastic demand changes price behavior. Analysts accustomed to cyclical commodity models struggle to adapt when demand refuses to respond as expected. Silver's recent price acceleration reflects this miscalculation. The market is learning, in real time, that industrial demand has crossed a threshold where price is no longer a controlling variable. When necessity replaces discretion, volatility increases, repricing accelerates, and what once appeared expensive quickly becomes the new baseline. Capital rotation towards silver is accelerating as confidence in traditional monetary anchors continues to erode. Persistent fiscal deficits, expanding sovereign debt burdens, and repeated episodes of monetary intervention have altered how investors assess risk. What was once considered extraordinary policy has become normalized, and markets are increasingly pricing in the long-term consequences of that normalization. In such an environment, capital does not wait for official confirmation. It moves preemptively toward assets that cannot be diluted, deferred, or restructured. Silver occupies a unique position in this shift because it bridges monetary hedging and real economic utility. Unlike purely financial instruments, it carries no counterparty risk, and unlike many commodities, it has a long history as a store of value. As purchasing power uncertainty rises, investors seek assets that exist outside the balance sheets of governments and central banks. This is not an emotional response. It is a rational repricing of monetary credibility. When trust weakens, capital seeks independence. The speed of this rotation is driven by asymmetric risk perception. In fiat-based systems, downside risk is no longer evenly distributed. Currency debasement, yield suppression, and debt monetization disproportionately penalize holders of cash and fixed income assets. As real yields compress or turn negative, the opportunity cost of holding hard assets declines sharply. Silver benefits directly from this shift, not because it promises yield, but because it preserves optionality in a world where policy flexibility comes at the expense of currency stability. What makes the current environment especially potent is the synchronization of global pressures. This is not a localized monetary issue confined to one economy. Multiple jurisdictions are grappling with similar constraints, forcing investors to reassess diversification itself. When correlations rise across traditional asset classes, portfolio protection becomes harder to achieve through conventional means. Capital rotation into silver reflects a search for assets whose value drivers are structurally disconnected from policy decisions and credit expansion. This movement is often underestimated because it does not announce itself loudly at first. Institutional relocations tend to begin quietly, through incremental adjustments rather than headline trades. Yet once momentum builds, flows compound rapidly. Silver's relatively small market size amplifies the impact of even modest capital inflows, accelerating price movements beyond what fundamentals alone would suggest in larger asset classes. The critical hook lies in timing. Monetary instability does not trigger rotation all at once, it builds pressure until thresholds are crossed. When investors collectively recognize that policy tools are constrained and credibility is diminishing, the shift becomes reflexive. Silver's recent behavior suggests that this recognition is spreading. Capital is no longer debating whether monetary risk exists. It is acting on the assumption that it does. When that assumption takes hold, price becomes the messenger, not the driver. The silver market's sensitivity to leverage and short exposure creates an environment where price movements can accelerate far beyond what fundamentals alone might initially justify. For decades, silver has been characterized by an unusually high ratio of paper claims to physical metal, allowing large positions to be built with relatively limited capital. This structure appears stable during periods of low volatility, but it becomes inherently fragile once price begins to move decisively against dominant positioning. Short exposure plays a central role in this dynamic. When prices rise gradually, short sellers can manage risk through rolling contracts, adding margin, or relying on historical mean reversion. However, sharp upward movements compress decision time. Losses expand nonlinearly, margin requirements increase, and the ability to maintain positions deteriorates rapidly. What begins as a controlled trade can transform into a forced exit, not because of a change in long-term outlook, but because of immediate liquidity constraints. This is where leverage amplifies volatility. Futures and derivative markets allow participants to control large nominal exposure with minimal upfront capital. While this enhances efficiency under normal conditions, it also concentrates risk. As prices move higher, leveraged short positions face margin calls that compel liquidation. These forced buybacks add demand precisely when supply is least flexible, accelerating upward price pressure and reinforcing the move that triggered the stress in the first place. The feedback loop is powerful and often underestimated. Rising prices trigger margin calls. Margin calls trigger short covering. Short covering drives prices higher. Each step compounds the next, creating momentum that appears sudden and disorderly to outside observers. Yet this behavior is not irrational, it is mechanical. The rules governing leverage markets ensure that once certain thresholds are crossed, volatility becomes self-reinforcing. What makes silver particularly susceptible to this effect is its relatively small market size compared to global capital flows. It does not require a large reallocation of capital to overwhelm available liquidity. Even modest disruptions in positioning can produce outsized price movements. This asymmetry means that once leverage begins to unwind, price can travel much farther and faster than most models anticipate. There is also a psychological dimension that intensifies the process. As prices break through long-standing resistance levels, confidence in established trading ranges erodes. Participants who once relied on historical behavior are forced to reassess assumptions in real time. Risk management shifts from optimization to survival. In such conditions, the priority is no longer maximizing returns, but minimizing exposure to escalating losses. The critical hook lies in recognition. Markets dominated by leverage appear calm until they are not. When the unwind begins, it rarely unfolds gradually. Silver's recent volatility suggests that this process may already be underway, signaling that price is no longer being guided by incremental positioning, but by the rapid unwinding of accumulated risk embedded deep within the system. Exizon 400 wards and don't TADD adding ADNG sandi closely OC muzzle ET moards and ET mower per RFS EV and GG and ADD hokase cheese. Long-term valuation frameworks increasingly suggest that silver is operating well below levels implied by historical pricing, monetary expansion, and global debt accumulation. Traditional spot prices often fail to capture the broader monetary context in which assets are valued. When currencies expand faster than productive output and debt grows faster than income, nominal prices across real assets must eventually adjust upward. Silver's current valuation reflects a prolonged period of distortion rather than equilibrium. When adjusted for inflation, using alternative measures that account for money supply growth rather than consumer price indices alone, silver's prior peaks translate into substantially higher modern equivalents. The 1980 and 2011 highs, when recalibrated against today's monetary base and balance sheet expansion, imply price levels far beyond current ranges. This is not a projection rooted in optimism. It is arithmetic applied to a changed monetary landscape. Global debt dynamics reinforce this perspective. Sovereign, corporate, and household liabilities have expanded to levels that constrain policy flexibility. Servicing this debt without financial repression becomes increasingly difficult, encouraging negative real rates and currency debasement as implicit tools of adjustment. In such an environment, assets with fixed supply and no counterparty risk are repriced not for yield, but for preservation of purchasing power. Silver fits squarely within this logic. The relative undervaluation becomes more pronounced when compared to gold. Historically, the gold-to-silver ratio has oscillated around long-term averages that reflect both scarcity and utility. Extended deviations from these ranges have typically resolved through silver outperformance rather than gold weakness. The current ratio suggests a market that has discounted silver's monetary and industrial relevance far more aggressively than fundamentals justify. What creates the hook is the asymmetry of adjustment. Revaluation does not occur linearly. Markets can ignore undervaluation for extended periods, but when recognition arrives, repricing often happens in compressed timeframes. The shift from indifference to urgency changes behavior quickly. Capital inflows accelerate, inventory tightens, and price benchmarks are reset higher as the market searches for levels that balance supply with demand under new assumptions. Valuation regimes also evolve alongside macro transitions. As confidence in fiat systems weakens and hard assets regain strategic importance, historical comparisons regain relevance. Silver's role as both a monetary and industrial asset positions it uniquely within this transition. The implication is not that price must return to past highs, but that the reference frame itself has shifted. Once markets internalize that shift, valuation ceases to be a ceiling and becomes a catalyst for repricing. So this is the question you must answer for yourself. Will you react later, when fear replaces clarity? Or will you recognize the signal while it's still early, uncomfortable, and doubted? Because wealth is not built when everyone agrees. It's built when conviction meets opportunity before consensus arrives. History does not repeat, but it does rhyme, and every major monetary reset leaves clues. Silver exploding $10 in 5 days is one of those clues. Ignore it, and you'll watch from the sidelines. Understand it, and you'll realize this isn't about chasing a price, it's about positioning for a shift. The panic has already started. The move is already underway, and the question isn't whether silver can reach $100. The real question is whether you'll recognize what's happening before the world is forced to admit it.